Right, jet setters. Here we go. These are the markets I'm looking at the moment. Let's have a bit of a run through, hey? S&P. Yeah, weekly it's done. It's the futures, right? That's why it's open up here. Weekly it's done this little routine. Bearish. It couldn't hold that level. Bearish. On the Fibos, look at that, bang on the 61, it rejected, bearish. Weekly RSIs, still coming down, fair way to go, bearish. As you can tell, I'm short this, right? There's a gap in here around that 4,000 level, which I've been looking for it to fill for a while. The fact it hasn't held this line, you can see it came through like on the dailies, but on the weeklies, no. That's pretty bearish. But having said that, the strength of this market, it is always call me out. Right. If we look at the extensions, where it can go to, it's right there, right? If we go from the candles, it's right on 4,000 in that sweet spot. I think the way that the Elliott wave guys would count this is definitely like a 1, 2, 3, 4, 5, okay, and here like it's an A, B, and then a C coming down there. I could be wrong. As I said, I'm pretty skeptical of the whole Elliott wave thing. In hindsight, you can find them, right? I've never, ever, in my entire trading life, I'm just going to bank, met anyone who has made money off trading Elliott waves, because they're all a beautiful hindsight thing. You know, you listen to guys, they say, well, it could be this, it could be that, it could be... They don't know. You can only, like, basically map the patterns after the fact. It has got to be, my thing, one of the worst things for looking at forward price action, and to trade off, ridiculous, right? You never see a global hedge fund with a Elliott wave strategy because they don't exist, right? Unicorns. So that's the S&P. So I'm bearish that and am short. In the Aussie market, it's, you know, strength of commodities has really helped our market. This has been a very strong one for one, you know, like wave in here. You can see it's like literally to the ding to the dong. You know, from there, I guess you can put it up there, right? From the candle, right at the edge of the candles. You know, but anyway, it came right up to the 1-to-1 ratio, that move. Right at the top of the overboughts, not quite overbought on the dailies. On the 4 hourlies, it'll be overbought coming off. Yeah, overbought, just coming off. So you can see that momentum weakening here, and that trend line there, however you want to draw it. There. That's a problem with trend lines. Very subjective. In any case, I'm short that. I believe it's going down. Aussie US, the battle of the rate things at the moment. I've been long you know, am of the view that it's you know, very much on the way back to you know, to the 80s, to par. You can see how some of these moves have traded, you know, really nicely, you know, in terms of those projections, and I expect it to do the same on the way up. And you know, you can see 85, that's at 61, you know, retracement up to 95, up to $1.10. You know, they're all big, strong technical levels on the way back up. Inevitably, because that's the way it came down. I was long a few, took one off. we'll look to put some more back on if it continues this dip. At the moment, it is kind of caught in this range, and it's a bit of a battle of the rates between the Fed and the RBA. Like, it spiked up here with the RBA saying, well, we're going to raise, came off when the Fed said, well, we're going to raise. The dollar strength is obviously wreaking havoc with the Aussie, but I do think that the commodities story will trump that. Gold, I'm short gold again. I'm bearish on this. I really think it's had its chance to go bananas on the geopolitical risk as well as the inflation story. Inflation was that money. Geopolitical risk was this money, and it's all coming off. This is one of the big setups that I look for. I hate that word setup, where it has a big run up, a little pause in there, sideways action to lower, and then when it breaks, it really breaks down. Here it's done the same thing with a strong run up. It's had sideways actions to down, had a hiccup here, it's had a hiccup here, and I do think that it's going down there. Interesting enough, one of the reasons why I shorted it in here was when you look at it on the shorter time frame, it's got the exact same pattern here, but on a shorter time frame, right, where it's gone up, had a spike, some lower lows, had a little bit of a pause in here, and it's looking to go down there. So that was, in a way, I guess, tactical entry for a longer play. On the rates front, I'm short the 10s, short the 2s in the US, short the 10s in Australia, short the bund. This, and really, I've actually put a steepener on when the curve was flat to slightly inverted, like a 10s, 2s. And kind of people look at the steepener, flattener, kind of whatever, right? Out of these YouTube muppets, you never hear them actually trading it, right? Well, I've traded it. Short the 2-year bonds in here around September, October, ridden them all the way, and you can see it's come back to that trend line, and that's when this gap, that's essentially the curve, as it rallied back to this line and it flattened. That's when I put a steepener on. So I've got a few trades on there. I've got like a 2s, 10s steepener on. I've actually got a spread between the Aussie and the US 10 years. I've got that on. And in terms of steepeners, right, we talk about the curve being flat and inverted. The 2s, 10s is sort of like the rank amateurs one to watch, because it's easier to trade, right? The real one to watch is the short-term curve between 3 months and the 10 years. But it's harder to trade because the 3 months you've got to roll, obviously, and as you keep rolling down the curve, you give up a lot on the just on those rolls. So what I did in the Aussie market, you can see here, these are the 3 month bank bills in Australia, right? And these DEC 23s, they're trading at 3.6%, right? You can see that's the highest rate. They're implying a forward rate of basically cash being slightly shy of 3.6% in DEC 23. The Aussie 10-year bonds at the moment are 3%, right? So the curve in Australia, right, if you roll clock forward, is inverted to the tune of 60 points, right? It's a similar thing in the US, actually. Like the US Eurodollar futures DEC 23, they're implying basically a little bit less, like 3.44%, right? So the curve that you really should be looking at, which is cash to 10 years, right, is not just flat, it's actually heavily inverted, right? So that's the steepener that I've put on in Australia. So when people talk about the curve, and if you're looking at these videos, inevitably you will be listening to people rabbit on about the curve. Don't let them get away with just talking about the 2s, 10s. Don't let them get away talking about it, saying, well, I haven't even traded it, like the Jubs. Let alone the fact that most people haven't started talking about it until, a few months ago, rather than 6, 7, 8 months ago. You need to look at the actual whole curve. Interest rates are a lot more complicated than just a 2-year and a 10-year. End of rant there. Another one, the bonds, I mean, short them. Look at that, off a cliff, right? They've been good. They're like reasonably punchy little contracts, the futures ones. But, you know, they're good to trade, so I've made some good money off them. I've been short them for a little while. They're trading at around about 70 points at the moment. Let's just have a look at them. And been short them since it was basically flat, like down here. Look at that, nice break, boys and girls. You know, these I think have got like a fair way to go, and you can see there's a good little gap in there, which they have just touched on, could be coming to. Right, Bitcoin. I don't trade Bitcoin. I think it's a joke. I need to look at logarithmic actually. So, you know, to me, this is a classic bear flag going on right here. Right, it's down, it's just come up, hit the overbought on the dailies just. Watch out if it breaks through here. The projection, 30,000, then 12,000, right? You can see, now the interesting thing, you know, 30,000 there, that's a very good round number that it's come off. I'd say very good chance of it getting there. This here, that's obviously the previous breakout level down here. Very good chance of it going there. I've rambled on about this one before. You can see it's a little bit lower, actually around about 11,000, right, when it broke out. You can see here, this pattern here, that is one of my favourites, right, which I've talked about in gold. Goes up, has a nice strong peak, dwindles down against a neckline, and when it falls vertically. You know, arguably there's one in here, forget about this noise here, where it has strong run up, came down, when it came to that neckline, then it came off. Those sell-offs, they're like 85, you know, 85%, right, from there to there, 87%, whatever. This one, 83%. This one's a bit different, right? But if it comes down 80%, same thing. That's actually the level that it comes to. All roads lead to Rome. I guess, you know, the counter argument, which I don't buy into whatsoever, is when you look at the trend here. Oops, hang on, let me just get this going. It could be going, you know, up to, you know, $500,000, as Elon Musk says, or whatever, right? But here, you know, that's kind of like $300,000 in time, right? If it goes up based on those technicals, that up there, you know, 340,000, whatever, right? I think if it ever gets there, the central banks will obviously flip their lid and kill it. And the last one, of course, the Nasdaq, you know, and really, you know, we do the ultimate sin and look at this on a non-linear basis, you know, on a linear basis rather than logarithmic. I mean, you just look at that, you know, these spikes, right, they only end one way. They only end one way, right? And that is in tiers, and suddenly you can see how it's spiked up, comes down, has a bit of a chop, and then it plummets. Now this is a bit of, again, once again, my favourite little pattern, you know, in a slightly different format, but the story is the same, where you have a very sudden run up, you know, indecision at the top, and then it comes down. You can see it has started to do that. I guess, you know, if you look at it, where would it come back to? There's that point there, right? That'd be interesting, wouldn't it? Let's look at the RSI on this thing quickly. Really strength indicator. Yeah, well, maybe on the monthly. Yeah, look at that. So heavily bought on the monthly. I mean, that is just rude, isn't it? Right. It could be a real disaster when this thing comes back, which it will. Obviously not as bad on the linear scale, but you can see it is definitely topping there. And to me, that level in there that it didn't break through, even though it has had the chance, decidedly bearish. And to me, it is like doing a bit of a wedding cake on the way down. You can see here this level in here, it hasn't been able to hold. Okay. Yeah, very bearish, that one, not looking good at all. And the last one actually that I'll look at is the Russell, which I find is probably one of the more intelligent markets that seems to obey some of the fundamentals. I don't know, that's my stupid charting software. It's doing again that same favourite pattern of mine where it's had a run up, just total gap, sideways action, little lower lows there, bit of a last gasp hop, pause beforehand, and it's on the way down. I mean, that isn't the technical handbook. That is a total and utter bear flag without a question. So if there's any, see what it's come back to, right? 38, right? And if there is any truth whatsoever to technical analysis, which I don't think there is, you know, then, you know, this, depending on your read here, takes it to the bottom of that that range, which is the breakout point, 1600, which is 16.5% to go, down 30% from the top. Sensible correction in my view. Anyway, look, that's about it. So that's the equities, bearish, bonds, bearish, curve, steepening, gold, bearish, bonds, bearish, Bitcoin, bearish. Yeah, you get the gist. All right, have a good one, and all the best. By the way, this is not advice, right? This isn't a real education. This is like my trading diary. If you're planning to trade, right, the way I do, my only advice is do not do it, right? Do not do it, right? It's risky. You can dust a lot of cash very quickly. And the second piece of advice I've got is you may well have seen Greg Secker and his party pals spamming via YouTube ads, right? The guy's full of shit. Whatever you do, do not sign up for his dreams, right? Look at his CV, right, on LinkedIn. Look at mine. And when you see the CVs, think about who you want to listen to in terms of advice on financial markets, right? Or their thoughts on financial markets or their commentary. You know, that guy, he's got absolutely 2/5 of fuck all real world experience. He's a con man, in my view. He just wants to sell you a trading system. He wants to sign you up to his trading room to charge, so he can charge you, you know, 5 times the bid offer spread that you'd get in other retail markets in foreign exchange. He's got an Australian offsider who has got a degree and background in media, right? In basically advertisements and, you know, not movies, right, but, you know, videos and stuff like that, right? These guys, they might have trained hundreds of thousands of people. Where are those hundreds of thousands millionaires, right? They're certainly not out there being millionaires. They're certainly not out there in the industry. They're certainly not out there running hedge funds. They are licking their wounds. So when you see that guy's spam, or another guy, John Howell, who has a similar kind of bullshit going on, do not do it. There's another guy, FX Evolution, Tom, full of shit, man. Like, if you see anyone that is wanting to sign you up for a chat room, right? Anyone is wanting to rope you in for a training course, a free webinar, any of those things, they are scammers, right? Full of shit. They're trying to sell you a dream. Do not do it. If you want someone to listen to apart from me, look up Chris Lewis from FX Empire, or look up James Stanley from, I think it's Daily FX or whatever. James Stanley is on Twitter. Chris Lewis is on YouTube. These guys are not trying to sell you anything. They've got qualified. They've got decent CVs. They've got tertiary education. They're working for genuine providers, financial services. They are not trying to rip your eye teeth out and sell you a dream. They are just talking about the markets. Listen to those guys. Those other shysters fucking run a million miles. All right, that's my 2 cents. Have a good one. We'll catch you later.